All righty, good morning. Time to get on with it. It's 6:30 something. 6:33. It's time to get our global macro on. Let me pull up QuantBox.co. This is our opportunity to get together as a group and uncover the best fundamental opportunities across global markets. My name is Wayne McDonald. I'm a trader, I'm an investor, and I'm a properly educated economist. Cool. And I started QuantBox because I wanted to automate the dirty work of all my economic research that takes up all my precious time. And so QuantBox goes through and gathers from various private and public databases, things like the Federal Reserve. How about the OECD, right? How about the CFTC? We gather all this data and then turn all the tables and spreadsheets into something beautifully understandable, right? Through visualization tools. So you can just very quickly say, based on the CFTC and some math, of course, you need some math. CFTC tells you this on the right, but CFTC doesn't tell you the left. So you either have to get the data from a source or you have to do the math. For example, the CFTC will tell you the total number of contracts traded on the exchange, and then it'll tell you all the commercial positions, and then all the institutional speculators, and then you subtract all that out, and there's still a number left over. What's that? That's this retail stuff, and then you combine them. And so, anyways, the math is tedious. Gathering the data is tedious. It takes time. It takes expertise. And I'm like, I'm tired of doing it myself. So QuantBox just automates it and makes it look all pretty. So you can say, see, there's my thoughts organized based on interest rate divergence, unemployment data, inflation data, GDP data, technical trends, seasonality, retail sentiment, commitment to traders report, and not just for these pairs, because that doesn't exist. That's comparing and contrasting those two pairs for all the pairs and all the indices and all the commodities. And you're like, holy smokes, it's a lot of work. So now it's automated. And I'm sharing this with you. I think you should understand why the market's moving, and this helps you understand that. If you're watching this on YouTube, your video is delayed many hours. Holy smokes, time to get on with it. Why don't you join the community and stop trading like a retail trader and start trading like an institutional trader? The trial is $8. Cool. With that being said, let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Let's log in. Now, today we got some big news, and tomorrow we got some big news. Yeah, this is it. We got the catalyst, which is the plural of catalyst, I think. Okay. So we know the week was backfilled, and now here we are at the back end of the week. Yields are still skyrocketing. Holy smokes. Holy smokes. Wow. Yep, on our way to 5. Amazing. What this is telling us is the market is pricing in another rate hike, and or I think the real story, what's going on, is the quantitative tightening that the Fed is doing is taking hold. Now, in yesterday's Q4 Global Market Outlook, I hope you attended. I took all the money I made for $10 a ticket, and I bought another Lambo. Now you have to love me. Huh? Now you have to love me. Anyway, so yeah, it was $10. But here's the thing. One of the things we looked at is the Fed's balance sheet and how it's being managed. And I think, now that they've sold off $1 trillion worth of bonds that they held on their balance sheet, we're starting to see perhaps which bonds they held. right? Which ones they held? 30-year, 20-year, 10-year, because that end of the yield curve is being most dramatically affected. And of course, the Treasury is also trying to raise money. So the other thing I showed is basically the government's balance sheet. I didn't show the balance sheet. I showed spending. Spending is higher now than it was during COVID. How could that even be possible? But I showed that. So how does the government pay for this? Well, in this case, probably selling a lot of treasuries. So when you see the Treasury selling treasuries and the Fed selling treasuries, yields go up. That's what happens. Lucas says, could QuantBox be programmed to have a new squawk with an AI voice? Hmm. That's a really good thought. Um, really good thought. I don't know. Maybe. I don't think that would be impossible. The thing is, what you want is you want it to actually say something intelligent, right? So, yeah, yeah, like the old trade the news. Well, that's the thing. I don't know if the machines are that way. They're not that human yet, but I guess it's pretty close. So, but it would have to like gather the news and then read it to you, and it would have to be new. Well, so maybe the answer is maybe. Um, I'll keep that in mind. It's an interesting thought. All right. So, anyways, gold back below 2000. Oil had this big move. I think we went up, tickled 95 and dropped. Now, the cool thing is that was a pivot point. Yeah. So the market is logical here. Okay, S&P 500 maybe stabilizing. Huh? Remember the trade plan from a couple of weeks ago was buy the S&P 500 at 42 and then maybe 4,000. I think 43, 42, and then 4,000 were my three numbers. And so, anyways, it's interesting. The drop seems to be slowing down. But of course, the big news is today, and the bigger news is tomorrow. So I suppose none of it matters. Okay. Everything's likely to change today and tomorrow. Euro dollar, though, holy smokes, huh? Remember, we were stuck around 110 and 108, and then back to 19, and then back to 110, and then down 1 to 7. It is very bearish and continuing its move down. Now, of course, QuantBox has had it very bearish for a while. A score of negative 12. I guess if you could go negative 13, it would do that too. Like oh my god, maybe it could. The evaluation should be very, very, very bearish, right? Like, yeah. So, anyways, don't. Yeah. So, anyways, down. Holy smokes! And Bitcoin seems to be stabilizing. We've been around this 26,000. Seems like forever, but what this doesn't show is the volatility around. Like Bitcoin will go up $700 and then drop $700. And you're like all in a 4-hour round trip. So that means for many people, they get run over a bus, then it stops, beep, 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 and backs up over you too. So, anyways, holy smokes. Stock markets have been quite flat going back the last few days, but generally more down than up over the last few days. Okay. So definitely some risk off. Thing is, are we going to start stabilizing? Let's take a look at the longer term gauges. Okay. Remember, these were -5 and then -4. Now they're -2. Maybe some stability. Now remember to look at this. We're not looking at technical analysis. There's no technical trend on this analysis, but we're looking at what the US dollar is doing, being the reserve currency. You want to track that over various periods, daily, weekly, and monthly. You want to look at the volatility in the stock market. In particular, what's happening here on the VIX is when institutional investors are worried the stock market's going to fall. and they have $1 billion position in stocks that took them a year or 2 or 5 to build. They're not going to get out because they're worried the stock market's going to drop 10%. But they can't do not nothing. Is that a good double negative? No, I don't think so. So they can't do nothing. They have to do something. So what they do is they hedge. They buy options on the S&P 500. That's actually what the VIX is measuring. So institutional investors are essentially buying insurance on their portfolios. Okay, great. When do they do that? When they feel good? No, because it's a waste of money. You don't need flood insurance at the top of a mountain. Okay. So if the stock market's going up, you don't need these options, and VIX would be low. So a low number is a good number. A 20, like almost a 20% increase, and I think it was 20% recently, right? A 20% increase in the purchase of insurance on stock portfolios. Yeah, that's bad. But it seems to be waning. Yields are up. That's bad. I mean, up a lot. That's bad. Think of it this way. Why is it bad? It's the cost of money. Do you want to pay more for money or do you want to pay less for money? Yeah. S&P 500 is down over the last month. That's bad. Okay. Gold is down. Maybe that's good. No, looks like everyone's going to cash is what it looks like, huh? Sell the stocks, sell the bonds, sell the gold. What do you buy? You're just converting everything back into dollars. So the dollar is strong, but maybe you're not buying dollars. You're just converting other instruments back into dollars. Okay. Yen is down, but that's good. So that's how we get this data. I think it's extraordinary, right? It's extraordinary to have this kind of data at your fingertips. So you can just look at all these markets, go boom. All right. Right. And then, of course, you got to pay attention and watch the swing in these as they move over time. So right now, the things you're bullish on, Swissy, yen, and dollar. Swissy, yen, dollar. Today, obviously, we're waiting for the news. Do, 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 do. This is calendar bugs me. I'm gonna have to yell at the developers and hurt their feelings. Make a millennial cry. Look at this. I don't understand what are they programming? 1 day away, now 19 hours away, and then 22, but then what? 2 days? Like what? I can't find what anything on here. Stupid programmers. All right, so this is tomorrow. This is what we care about tomorrow. I can't even find what I'm. Good thing I know it. I'm pretty sure we have GDP today, right? Man, I gotta yell at these developers. Your calendar sucks, developers. Am I right? We have GDP, right? So funny. Yeah. Well, anyway, so we got GDP today. We have core PCE tomorrow. These are big movers. One, because we want to know if growth is changing, because growth is good, the Fed expects growth to slow, which is good. But we don't want to end up in a situation like the UK and Euro where there is no growth. Okay, imagine people going to work all day and then they go home and the beautiful person waiting for them at home says, "Oh, hey, honey, how was your day?" "Yeah, I didn't do anything." "Well, you went to work and you didn't do nothing?" No, I wasn't productive at all." "Well, I did 0.1% of my job." Which is next to nothing, right? So, anyways, it's just amazing to have a whole economy not be productive. Wow, is that unusual, huh? And then, especially when you look at like inflation in the UK is super high and there's no productivity. Like, what? It's really strange. So, we want to make sure that the US maintains decent growth. We understand. And I cover again, here's a plug for yesterday's event. We showed GDP. We showed the expected change in GDP going out like 18 months. So we understand slow, maybe it over time it drops to 1.5% from 2.2% or 2.5. So we go from 2.5 to 1.5. That's cool. We're good with that. If it drops to one, yeah, that's still okay. But like this whole like zero nonsense, no. Okay, we don't want to get there. But we do want to slow the economy down, and maybe that brings inflation down. Okay. I think one of the things that'll happen, and we've talked about this before, and now it definitely looks like it's going to happen. Oil and therefore later gasoline, and in the winter, like heating fuel and the cost of electricity is going to go so high again this year that you're going to spend all your money on gasoline and heat because you have to have that. That you're not going to have money left over to go to Applebee's for dinner. And you're not going to be able to fly to grandma's house for Christmas. You're going to stay home. And that's the slowing of the economy, but also, therefore, other things other than this food and heat and fuel for your vehicles. Right? There's no money left over to spend on the other things like travel and leisure. You're not going to go to a Marriott. Or if you are going to go out, you're not going to stay at Marriott. You're going to stay at, I don't know, what do they call them? Red Roof Inn or something. Right? Yeah. And don't bring a black light with you. Yeah. Do not bring a black light with you. Yeah. So anyways, you will change. That's what the study of economics is. Scarcity. You have to have fuel to go to so you can go to work. You have to have heat so you don't die. You have to eat food so you don't die. And if those things cost more, then other things don't get purchased, and maybe that's what brings inflation down. So you'll have to thank the world, right? The high energy prices. The sad thing is, if that fixed it, then last year when we tapped the SPR to lower energy prices, then all we did was give up a strategic petroleum reserve. But at the same time, if high energy prices would have eventually slowed the economy down, then the Fed wouldn't have had to raise interest rates so much. And if the economy was slowing down, inflation would be coming down. So all we did was prevent the cure. Thank you, government. Right? So, anyways, yeah, take a look at the scatter plot. Oh, it's a funny glitch that happens every once in a while. Why doesn't it expand? Well, maybe I'll just zoom in then. Okay. Well, I see a lot of dollar, huh? Dollar strong, dollar strong, dollar strong. Okay. All right. CAD strong. I was looking to see if it specifically yen or maybe is it Swissy? Because remember, we're very, very, very bearish on yen and we're very, very, very bearish on Swiss franc. And so we're looking at everything up. And so Swissy weak, yen weak, Swissy weak, Swissy weak, yen weak, Swissy weak, yen weak. Yeah. All right. Cool. Seems pretty okay. Euro, you can see, is a little bit different from all of that. Apparently, Euro's weak. Weaker than Swissy. Weaker than yen. Yeah, well, we know that that started the instant Christine Lagarde during the ECB meeting told us, remember? And we actually read the statement, and it was in the first paragraph. I highlighted it. And in so many words, not directly, but it said, or certainly suggested, they're done raising interest rates. Sell it. It's fundamentals, guys. It's fundamentals. And euro is crazy weak. Euro's weak against CAD. Euro's weak against Kiwi. Euro's weak against odd. Swissy, yen, and Swissy and yen are terribly weak. So yeah, the biggest dog, the smelliest dog is that euro. So we can pick on euro then. And then you can pick on like a Swissy, for example. Okay. So I pointed this one out a week and a half ago. Okay, it hasn't worked, but it hasn't not worked. Okay. It's slowly riding the moving averages down. But of course, there are concerns about the Aussie, and that's what's reflected there. Euro Swissy, we've triple topped at a monthly pivot point, which is our conservative projected high. Okay, Euro's weakening here. And the Swiss National Bank wants their currency to stay weak. So it'll be interesting if in this price area here, if the Swiss National Bank steps in to prop up the euro. And you're like, have they ever done that before? Oh, yeah, 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 yeah. Like they're notorious for doing it. Yeah. So, yeah, yeah, like for sure. Okay. Yeah. Let's see how far back I can go. Okay. Look what happens when the Swiss franc gets too weak. Pop. Swiss franc, I mean strong. Swiss franc gets too strong. Pop. Swiss franc gets too strong. Pop. Okay. Yeah. So you can see there's lots of volatility on this one. It's slow and then pop. Okay. Down, pop, down, pop, down, pop. So yeah, they do get in there. And this event here is what put major brokers out of business. If you weren't there to witness, okay, these are weekly candles. So imagine this period here. Let me just do it. That's 3 years. 3 years. That's the normal price action over 3 years. And then it dropped from 126 or 125 to 84. What? 20, 25, 125 to 115 is 1,000 pips. It's thousands and 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 thousands of pips in one candle. 15 to 20 years of price action in 1 week. That's when the Swiss National Bank stopped pushing the Euro Swissy up. So, yeah, that's what happens when they stop. So they definitely do stuff all the time. So just keep that in mind if you haven't been around, right? Yeah, they definitely are involved on Euro Swiss franc. So what else? What is it that you want to buy? Euro Kiwi is another one I've pointed out to the downside. That one's working better. I happen to do the video on the Aussie. I also did one on Euro CAD. Okay. That one's just been right as rain. And so, yeah, you know what? Swiss francs weak. Great. Great. The thing is, are you setting up a sell right here? Okay. So if you were going to try to trend trade, you're going to go, and your trade plan will be, let's say, what is this? Sell at 42.50, target 40.50. So 200 pips. Good coffee today, minions. All right. Gotta be nice to your minions, right? Thank you. I'll let you live another day. All right. Swiss franc. Do you want to buy the pound? No, it's like one of these things where I understand the pound is going to get strong just because it's so weak. So, I mean, look, someone's going to buy it, right? And nothing wrong with it. Aussie Swiss franc, we're just at the wrong price. Or let's say it's the right price, but the wrong time. The only other way of doing it is trapping it, right? So you guys recall that. You zoom in and you pick sort of a daily bottom, right? Trap it this way and then drop into a smaller time frame. Okay. And breach it, pull back, breach it, pull back, right? So let it break the range and re-enter the range, or buy it at the bottom of the range, right? Like the one thing we know for sure is that we're bearish on the Swiss franc. What we don't know is, will Aussie go up? So that's your job. Your first job is to know for sure you want to sell the Swissy. That's called macroeconomic strategy. You don't know nothing except you want to sell the Swiss franc because of the policy of the central bank. That is macro. Okay, great. So you're not sure about Aussie, but you definitely want this to go up. So a range trade, for example, is to connect these bottoms and say, this is the bottom of a range, and this is the top of the range. Okay, great. And how do you trade it? Well, you're definitely a bull. You're absolutely, totally not a seller. So you have two choices. Okay, buy at the bottom of the range, or let it break and buy at the top of the range, but now not as resistance, as support. So you break it down into digestible pieces. And the rest is just risk management. But you're not debating like, well, what if it falls? What do you mean? Like, I don't understand what you're asking me. Well, what if it falls? I don't understand. What do you mean? What if it falls? Swiss franc's weak. I mean, it's it's implausible. It's possible, but not plausible. So you're like, no, I'm a bull on this. I just don't know when or how fast it'll go up. Now we know Aussie's a mediocre one, but then you flip over and we already know this one is astronomical. Okay, so you should be setting up next week's trades, next month's trades. That's next week's trades, and next month's trades are down here again. So then you say, well, Wayne, I don't think it's going to drop down there. There's no reason for CAD to collapse unless oil collapses. And then suddenly Swiss franc gets super strong. You're like, I just don't believe that's going to happen. All right, we call that an out of position trade, and it's going to do this. And then profit taking. And we might find ourselves down here, Halloween or something. Cool. So, anyways, that one's working tickety boo, but we've hit target, and it shows even even at extreme levels, these pivots get respected. Okay, there's the predicted high for the month of September. This is that trade I show you how to do the Asian fade strategy from Investor Bootcamp's day trading course. Okay, remember, I'm like, look, all you have to do, set up the range. Okay, there's the buy zone. Okay, so it came down, and the target is up. Now, if you extend this a bit, okay, we've essentially just did another one. Cool. Day trading, that's a lot of analysis, though. So I would say, if you find yourself somewhere around these green zones, they might be buying opportunities, huh? So when we zoom into today, let me get rid of the fib. Okay, and I zoom in a little bit. Okay, yesterday's buying zone, yesterday's target, today's buying zone, and we're already on the conservative target, and there's a little bit more aggressive target slightly above us. Most of today's move is already done. Cool. Cool. Anyways, nice. Trend. Even that pound Swissy is showing that Swissy is weak. Interesting. It's just been moving sideways for so long. 1 year, in fact. That's 1 year of ever so slightly down but ever so slightly flat, right? Like amazing, right? Nothing happened for a year. Take a look at the yens. Kiwi now hitting target. So I'm in at 87 and now we're at 89, like the slowest 200 pips ever. Ever. You know how long I've had to do nothing? How many times I've had to do nothing over the last month for this trade? Only got 200 pips. Yeah. Anyways. So it's still just climbing. This week's target is what is that, 89? So we'll probably tickle 90 and then probably see some profit taking, huh? Cool, be interesting. Does anyone remember my target? December 12th. It's not even a price target. My big target, depending on if if that trade holds all the way to December, I might hold it all the way to Canada Day. Wayne, that's July. Yeah. Enter a trade in September and hold it to July. Uh-huh. That's audacious. How dare you? Well, I've never. Well, all right. So maybe we'll see. Oh, I'm on the wrong one. Anyways, it's funny. I wanted this one. Pound has been a dog with fleas, dropped to the support pivot, and now has made a higher high relative to this. Some cheeky monkey is going to kind of like look at it this way: was down and now up. Yeah. Okay, that's great. Because I've been praying for risk on. So that'd be interesting if that happened. Okay. This has been very strategically planned out for you. Okay. And really, we should be looking at the last move is like a follow on. So it also 618. So the first one's a 618. The second one's a 618. And we're ever so slowly working our way up. So we can get rid of this old 618. If I can get rid of that 618. And now it's repeated the 618. Can I get rid of this? No, I'm not going to be able to do it. All right. So, anyways, just slowly climbing. You can see my price action pivot points, which is a combination of standard deviation and linear regression. And so, anyways, it's okay. It's pointing like up, and like this is an interesting place for it to bottom, right? Because then it does predict up to what, 96, right? Maybe a higher high. So that's Aussie yen on a higher time frame, CAD yen on a higher time frame. And we're riding not the 2155, we're riding the 58. Whoa, that is fast. Yeah. Okay. And this is going back to like, if you're going to day trade, it's going to be exactly what I've taught you before. Okay. You're going to like measure the tops of candles and the bottoms of candles. And then on a smaller time frame, okay, you're going to look for opportunities. You're going to look for pullbacks because we live inside the wicks. So if this is a giant green candle, let me do it in green. If this is a giant green candle, you're going to buy a dip at support. And then you're going to have a stop below because that would be a lower low. Lower lows don't exist in uptrends. So you're like, well, this is interesting. This is interesting. So somewhere in there, of course, if you can't be damned to do that, you can just use a pivot point. It's going to tell you the same thing. It's doing similar math. Or you use Fibonacci. You're like, I love the Fibonacci. Okay, whatever. Buy the dip, bro. Right? But not a lower low. All right. So what are the likely possibilities? Plan A, plan B, and hopefully not, but is it possible? Yeah, plan C, I suppose, but not likely. That because that ends up putting you rangy. So that's not likely. So those are your two trade plans for CAD yen. Well, yesterday, of course, but I've taught you how to do this 100 times. Okay. Find something that's moving, something that's trending, something you can explain. I think you could probably explain why CAD yen is going up. Cool. So now you're aware of it. And then you're like, well, that's really good, Wayne. Great. You did yesterday. Okay. First of all, I don't appreciate your tone of voice. Um, then let's pretend that's the high for today. Let's pretend that's the low for today. That's actually yesterday. But nonetheless, we're going to plan it out because today was based on yesterday. And one of the things you could be looking at is that's a 50% Fibonacci retracement. So your trade plan for today might be like that. Should it be down here? Well, it could, but you don't want it to do that. Technical analysis might help you identify the probability of that. But for that to happen, right, price would need to collapse below this price. But we've already identified that as an important price, which would likely to be supportive. So this X down here is possible, but not plausible. Okay. And what might be happening is you're talking yourself out of trades. Okay. You're not talking yourself into good logical trades. You're talking yourself out of all trades. Well, what if it collapses and falls down there? Dude, did you look at the daily chart? It's been going up every day for like 3 months. We're riding the 5-8 for crying out loud. Like, buy the dip. Right? No, I want Euro Kiwi or something. They're like, oh no. Okay. Anyways, so I know this is tough. So I'm only being facetious because it's, again, I'm poking the wound, if you will, so that you remember not just intellectually. Intellectually, I know you understand this. So I have to appeal emotionally from time to time because it's tough to change behavior and old habits, right? It's tough. This is a tough gig. Okay. Cool. But the nice thing is about Forex is, well, if 95% of people flame out, that means 5% get to keep everything. But that's not fair. It ain't fair. Actually, it is fair. It's totally fair. So, anyways, I'll leave it at that. It's going to be an interesting day. GDP today, core PCE tomorrow. What's most important is not is what's right, but how the market reacts and how they think about it and fear about it or love it or hate it or misinterpret it. It's just, I think when you look at the facts and you look at the data, everything makes sense and everything is based on what we know and what we've been told. But when you talk about the market, all of that is irrelevant. It's like the market represents greed and fear, not just everything is in the price because everybody's logical. Really? Have you met everybody? Nobody's completely logical, right? And in particular, in trading and investing in the markets, everything is normal until it's not. And then suddenly everything's abnormal, and right, and the market starts to break down. And so really, I think the next couple of days, if people are afraid of what the Fed might do next year, then this is going to be hypersensitive. And since most people seem to guess, I mean, I'm talking about the people on TV behind me. They get up there and they guess. I I would say 5 out of 6 guests seem to be making it up. They have opinions. Like, it just blows me away. Like, they never just spout the facts. They like, well, this is what the Fed said. This is what the dot plot says. This is where the trend in GDP. This is like they're like, well, we think there's one and done. Like, well, what do you mean you think? So it's amazing to me, right? So people, when they guess, make mistakes. And when they trade based on what they want, they're going to make mistakes. Our job is to know what we expect, but also see reality. So we'll see what happens today. The number in GDP will come out and it might be down, and they're like, oh my God, that's good. But maybe they say, oh my God, that's bad. All I can tell you is, well, if it's a little low today, well, we talked about it yesterday in my Q4 outlook, and we went all the way to 2026. And then we talked about it when the summary of economic projections came out at the last Fed meeting. And we went through it and we're like, whoa, look, GDP is expected to be a little bit lower. So if that comes out a little bit lower, people are going to be surprised. Okay. But we also know not much lower yet because that also, like when you look at the summary of economic projections, it says lower, not now, actually. It says a little bit lower, but next year, quite a bit lower. Right. So we know like it should be about as expected, maybe a little bit to the downside. The bigger surprise is a great GDP number. And that could be the biggest spook where suddenly, well, what the Fed is doing isn't working. But we also know it's not a Fed problem anymore. So that is something to be worried about because the Fed might think the Fed is the solution to everything. So maybe they say, well, maybe interest rates should be 7%. That's what Jamie Dimon at JP Morgan is saying. Well, again, that would be his opinion. I don't trade opinions. So we would need a change in stated Fed policy. We would need a change in the summary of economic projections. And then I could take on some of those, changes into my models. But we're not there. We're not even close to being there. All that kind of stuff, to me, is irrelevant noise that doesn't exist to me. Right? Like whining and crying. It's funny how I tune all of that out. So very often, like especially when my kids were young, they'd be whining and crying about something. And then I look at them like, are you talking to me? It would make them so mad. I'm like, Like, and I'm not even joking, right? So anyway, so all this, well, what if, what if, what if? No, 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 no. So GDP is probably going to be as expected, and right, and that's already in the summary of economic projections. And if anything, it might be slightly lower, which is actually good news. But I don't know how the market's going to react to it. It might be a giant surprise. And what we need to do is pay attention to how the market reacts, put it into our model, filter everything out, and answer the the question, the address the 800-pound gorilla or the elephant in the room, and that is, should I buy a dip after a higher high? Uh-huh. Yep. Today we'll probably get some volatility. Maybe it does do one of these things. Well, then we'll get back on the horse next week. That's all. It'll work out. But that's not probable. It's possible, but not probable. What do you want to trade as a trader? What's possible or what's plausible? I'll take plausible all day, every day. So peace on earth. May the pips be with you. May your profits be above average. Trade safe. I'll see you when I see you. Cheers.